IT team, can we start off with this now? Kyle, can we start off now? Kyle, shall we start?
Hello.
Yes, I'll.
So we can start now.
We can
Yes.
start. Great. Hi, good morning, everyone. My name is Vijay Veer Singh. I am the Senior Vice President at Amity Innovation Incubator and your host for this session. Before we start off with today's session, I'll just take you through the journey of Amity Innovation Incubator. So we started our operation in 2008 under the aegis of our president, Dr. Asim Chauhan, sir, with a vision to ensure that a comprehensive startup ecosystem is in place to nurture entrepreneurs and strengthen innovation culture at grassroots level. We are supported by Ministry of Electronics and Information Technology, Atal Innovation Mission, Ministry of Defense, MSME, DST, and Start in UP. During our journey of 15 plus years, we had incubated and supported more than 750 ventures and have aided investment in 80 plus entities through Amity Capital Ventures, which is our investment vehicle, and also close to 18 exits to our credits. We have created a network of incubators spread pan India in presence in Noida, Lucknow, Manesar, Jaipur, Raipur, Gwalior, Mumbai, and Bangalore, along with international presence in Dubai, New York, Singapore, and Uzbekistan. We would like to express our gratitude to Meti Startup Hub for providing their continued support. Now, with coming back to today's session, key recipe of fundraising, VC's perspective, let me welcome and introduce our speaker for today, Mr. Edison Apu, a great all-rounder, I'll say, in terms of the funding side. He's a shark here with us. Edison leads Thinkuvate's Southeast Asia and India operations and looks after the deal flow, investments, investor connects, and portfolio management. Key sector focus includes health tech, fintech, IoT, AL, ML startups, deep tech, agri-tech, water tech, AR, VR, and infotech. He has led seed, pre-series A, series A investment in startups like Renticle, which was into shared economy furnitures, Signcatch, B2B fintech, One Play Sports, sports media tech, and Cure Skin, which is AI skincare, and many more such startups. He's also an active angel investor. He has experience in M&A, advisory, private equity, infusion, and valuation within the diversified sectors. Previously involved in investment banking, including M&A, IPO, private equity deals. Sir, we welcome you and over to you for this very insightful session, which we are looking forward. And I'm sure all the startups who are present here will definitely gain maximum out of it. Thank you, sir. Over to you.
Thanks,
We'll
Vijay.
make
Thanks.
interactive session for startups. Whoever has any queries, either they can put it in Q&A. Towards the end, we will unmute you and so that you can ask one-on-one. Over to you, sir.
Yeah, thanks, Vijay. Thanks for that quick download and thanks for making that kind introduction. Uh, Good afternoon, everybody. It is still morning, by the way. It's 11:35. So, good morning, everyone. As Vijay quickly pointed out, I'll take a few minutes to take you through our journey and who we are and what we have done so far. And then I'll also talk about the topic for today, which is about key recipe for fundraising and what does a VC look for. This is the buzzword that startups are doing well in India, and a lot of funding has happened, a lot of funding will happen. So, good quality ideas backed by founders with great execution skills will always have a lot of space for growth in this country. Brief introduction about Think You Wait. We started around 2015. Gansham, Ritesh are the two managing partners. Mayank is in Singapore. He's my colleague, and I am in India. I look after the business in India. We have invested in 20 startups. We also have our colleague in Mumbai and Simran and our other colleague in Singapore and Meenal. Um and Vikas is our partner in Singapore. We have a network of professionals who have worked for different sectors, different geographies at senior management positions, and they want to contribute back to the ecosystem. So we have a strong geographic presence. We have a diversified investor profile. Some of our marquee investments are mentioned below. We have invested in 20 startups. One company got IPO'd on the Australian Stock Exchange, giving us a multi-bagger exit. We have recently exited one of our Series B companies partially, and a lot of our companies are growing pretty fast as we speak. We are sector agnostic, early stage, invest in B2B or B2B2C startups. We haven't done pure play B2C yet, apart from a couple here and there. But the thesis is revolving more on the tech side. Jumping to the topic. So, what are the key questions when we evaluate startups? So, basically, this is the secret sauce of getting funded. First and foremost, and before I take you through some of the points mentioned on the slide, uh, the quality of the founder or the team is the first and the foremost requirement when you are taking a call on investment. And after that, the filter happens. So, here in this case, uh, I will discuss the core issues, but again, a complementary team of a techie and a business person always helps, because at the end of the day, ideas can be plenty, but execution matters the most. And when I say execution, fruition of the idea to a possible business which will generate profits. So always remember, business is about profits, business is about scale, business is about reach. So whatever you are building, if it is not scalable, if it is not profitable, then it is not a business. So execution skills are important, and execution skills are directly related to the capability of the founder. So founder metrics becomes the most important criteria, and this is the first and the foremost pillar of a, a VC looking into your company. So if you have a complementary team, there is a high probability that you will get funded. Then once we filter down, we will probably look at are you solving an unsolved problem or bringing efficiency to a current solution? In layman terms, it is like, are you reinventing the wheel, or you are finding a solution to a problem which needs attention? So problem statement becomes a very critical factor, if you ask me, and that is one of the critical that is one of the critical factors which determine whether this startup is going to get funded or not. Uh, we also look at the overall market, and when I say market, the total addressable market, in jargon terms, it is called the TAM. This is looked at because if you know the market is big, the size is big, there is a high potential that you can scale. And the idea is that whether you can grow 5x in the 3 years time frame. That is the thumb rule, where you kind of, if you grow 5x, there is a high potential that you will capture a significant portion of the market if your product is good. So scalability is the second big factor. So you can jumble between team execution capabilities and problem as one and three and interlock it. Scalability from a growth perspective and time perspective is very, very important. So that remains one of the second most important criteria. Uh, Third is we also look at competition, where you sit in the hierarchy, where you sit as in the form of strategic positioning, whether you are offering a cheap product or an expensive solution. Are you integrating backward chains, or you are adding value to the forward integration? Whether you are product you're doing a product diversification, or you're just bringing a solution from a different geography to your geography. And then we compare it to the other players in the market. When you are competing directly with someone, it's called pure play competition. When you are having a solution which may be sitting as a product in a larger suite of other competitors, we call it a indirect competition. But having said that, both play a critical part in the assessment process, because once you start to grow, once you increase your volumes, once you uh, start capturing market percentage or market share, there will be people who will come after you. When I say people, these will be your competitors, who will come and try and see to dislodge you from your position. So competitive landscaping and competitive positioning is very important. We This can be defended. So when we talk about competition, the first thing that comes is, how can you win over competition? If you ask me, there are some ways in which you can define that you have a better product. So one is, of course, quality. Second is bringing efficiency. Price plays a part, but price comes right below the bottom chain, because if you're just competing on price, a larger player will probably eat you up in long run. So price is not the core differentiator when you are always putting your competitive landscape table. You should first try and differentiate on the solution, on the product you're building. Second is how you're going to execute it. Sometimes just redefining some of the steps in the process can save you time and cost anyways. So that becomes a very critical part. If you are a pure tech company or build a product which can be patented, that creates a very strong defense mode. There are a lot of companies with utility and design patents. Utility still has value. Design, to my understanding, is the least of the uh, defensible patents that you can hold. So if it is product, process, or utility, it has got a lot of value in terms of your competition. And when I talk about how you're going to achieve it, so obviously, uh, you will probably come to me to seek funds to for a faster growth and gain market share. So every dollar that is invested in a particular startup, it is always a return ratio that is calculated. So the profits that you may make will depend on the size of the market, the speed at which you can execute, and the volume or the market share you can capture. If all the three fall into place, that means that you have a great story to narrate. So some of the factors which play a critical part, and I'll summarize this slide. First and foremost is the founder. Second, of course, is the size of the market, which is scale, TAM, whatever you can call it. Third is the competition. And when I say competition, who are the players who are there with you in this competing? Sometimes having a sole position is not great, because we call it monopoly, but in certain cases where you are trying to build something new, a lot of the money is spent on education and adoption, which we have seen in case of B2C businesses, where um, in order to attract a customer, you spend money from your pocket to ensure that is using your product or service in the first place. So that becomes a very critical part, the competition. Fourth is your execution skills, and of course, that translates into traction. So we'll also look at the traction data. And when traction, I mean, um, in a company's life cycle, there will be three critical stages. The first stage is where you start, you conceive an idea. The second stage is your minimum viable product slash prototype. So if you are a hardware company, you will probably create a prototype. If you are a software company, you will probably get a minimum viable product. which you will still test for bugs. The third stage is where you start to grow, and this is called product market fit. So basically, at that point in time, you will be able to define uh, that your product has a market. There is price elasticity in the demand, that more the demand, the price can be adjusted accordingly and passed on to the consumer for making profits. And that means you are on the right track. Having said this, this has to marry with unit economics. So when I say unit economics, what I mean is whether you will be able to make money per unit basis. So whatever you are producing, whether it is a software, whether it is a hardware, whether it is a brand you're wanting to create, a product solution or a D2C, you should be able to make some money on every unit you sold. That means your unit economics positive, because then if you multiply it with the volumes, you will obviously be able to bring down the cost because economies of scale will kick in. But at the same point in time, because your unit economics positive, your path to profit will be much more well defined. Or I would say you will reach profitability in the near future. There are very different, people who understand finance, who have studied finance, there is a large difference between becoming EBITDA positive and cash positive. Companies which really create value are cash positive businesses. But in this scenario, it will take its sweet time. But you should always understand that if your unit economics positive, there is a high probability in a larger frame of time, you might become cash positive. EBITDA positive is basically whatever you are producing and what you are selling, the delta is gross. And to ensure that you run the operations, if you subtract your selling and general administrative expenses, you get to your operational profit, which is so-called EBITDA. You add back the DNA of the fixed assets, which are either depreciated, or the intangible assets, which are amortized. But that does not mean that you have cash profits. Cash profits will entail from the fact that if you make profits on per unit basis after expending for all sorts of expenses. So that becomes the fourth pillar. Founder, scale, which is TAM, which is your market depth, which is your market size two. Third is your competition. Fourth is the traction, which I was talking about, and within traction, how defensible is your product. Fifth is, of course, and this should be least of your worries, because if you get the four things right, the fifth will obviously follow, which is called valuation. And I'll talk about valuation in a separate slide altogether, because this requires attention and strong discussion. See, there are investors who invest looking at valuation, and there are investors who look and invest getting value proposition. Valuation and value are very, very different. If you're playing the valuation game, you may or may not have profits, but you will still be covered in the newspaper. But that does not mean that you have built a great business. But if you have created value, then you will know that every shareholder in the business, if you start another business, they will be the first person to give you money without even asking you for a business plan. So that is the core differentiation between valuation and value. So if you look at a DMart, that is value. If you look at a cred, that is valuation. I'm sorry to take names here, but I wanted to put the point across that if you don't have a clear monetization plan, if you don't know how to make money, at the end of the day, the people who are trusting you or giving the money to you on the basis of trust, you should be able to repay that trust either through making money for them, or able to demonstrate that you had the execution skills of the plan you narrated to them on the day one. So what are the other factors you should look at? And these are driven by different stages or life cycle, points in the life cycle of a particular startup. At an initial stage, the valuation can be dependent on the idea and the team, and the range can go from anything from 1 million to 4 million. The ideal scenario of dilution is that you should look to dilute roughly, uh, if you have a strong execution skill, or you are a serial entrepreneur, or you have done this business before, you should target a dilution of 10 to 15% every stage. Or if you are doing it for the first time, maybe 15 to 20%. So by the time you cross say Series C, you should still hold roughly 25% of your business. And that is a very, very significant number that we are talking about. Because at Series C, you are roughly valued north of 100 million. So your own personal wealth creation would be around 25 million of the stocks you hold in that particular business. We also talk about pre-money, post-money. So valuation becomes the fifth pillar of the key perspective. To the point of repeating myself, I'll just summarize. So founder quality, size of the market, competition, traction, and valuation. These 5 points make a clear case study for an investor to invest in a startup. If you have these five, I mean, the fifth one will take care of itself, but if you have the first four, it is very difficult that you will not get funded. That means you have clicked all the right buttons. And we are talking about valuation methodologies. It can be different ways to look at a market. A lot of people a certain value on the revenue. Some people value companies for the reach, which we call the users base, the downloads of the world. Some people value the business on the basis of the operational profits you're making. Some people value your business basis the geographic reach or network you have in different countries. So there are very different parameters for different valuation metrics. In a startup scenario, see, the fundamental rule of valuing the business was discounted cash flow, but unfortunately in a startup you will never get a discounted cash flow, because discounted cash flow starts from operational profits, where the simple math starts from operational profits, and it is very difficult to expect a young business to show operational profits. Having said that, the projections should reflect a path to profitability in 3 years, if not in 5 years. And that is where the execution capabilities of the founders take very strong precedence. In terms of pre-money valuation and post-money valuation, it is more like educational understanding that whatever you raise, whatever you're looking to raise, you value your company, then you add the investment and you get to post-money, and then you can understand what dilution is all about. Uh, you should be very, very clear how much money you want, because in my experience, after talking to a lot of founders, we have seen uh, basically two approaches. A founder doesn't know. He first thinks I want to dilute X, and then he puts a number that I want to raise. And then when you divide the two, you end up getting a pre-money valuation which you cannot justify. Case in example, suppose you say I will dilute 10%, and you say I want to raise 5 crores. But when I'm holding 10% of the five and giving you 5 crores, the valuation of the business is 50 crores. Right? 50 crores, 10% is roughly 5 crores. And that too on a post money basis. So that means you have valued your business at 45 crore pre-money. You had 5 crore as your investment and 50 crore as your post money. And then I can control 10% in the business. So if you put the dilution number first and then put the investment number after that, and then you will get the valuation number which you cannot justify, you will it is a spiral. It's a very vicious cycle that you can't come out of. Then you will try and justify all by hook or crook what the valuation is, because at early stage, believe me, you will not have the numbers from a multiplier aspect also to justify that valuation. So my humble request or suggestion to all of you would be, first and foremost, sit with your guy who understands numbers and try and plan how much money you require for, say, 24 months. If you are spending roughly, say, 10 lakh rupees a month, or 15 lakh rupees a month, or say 20 lakh rupees a month, for 24 months, you will end up requiring 5 crore rupees, right? 4.8 to be precise. Let's add a 10% swing to that, because there will be miscellaneous expenses which you cannot foresee at this point in time. Now, if this 5 crores is good enough for you to sustain your business for 24 months, then you should always think that how much revenue can you generate? If you're doing the right things, you may get a revenue of say 5 lakh rupee a month over the next. So first 12 months, there may be no revenue. From the 13th month to the 24th month, there will be maybe revenues of say 5 to 10 lakh rupees a month. So for the whole year, you may end up doing a crore. So that means out of the 5 crores, 1 crore will come from the revenue part. So you will end up only losing 4 crores and you will still have 1 crore in the bank by the time the 24th month comes to a close, which entail will give you a runway of another 5 months to raise the next round mathematically. So as a founder, as an execution guy, you should be able to know all this. Now, when you are going for this first round, the first round is always very expensive because you are trying to sell a story, selling an idea without much of uh, the follow through. When I say follow through, potential traction numbers which will attract a seasoned investor. So dilution can be a tricky situation, but the first round is always expensive. But if you are doing something correct, you first find out how much money you require and then put the dilution number accordingly, because then you can get a valuation number which will be much more justifiable. So those are the five key ingredients: unit economics. If you can build up a patented business, all those things make a lot of sense. And I will stop sharing my slides and now I open the floor for questions because I believe there will be questions. I wanted to do a 30-minute presentation and keep as many questions that I can answer over the next minutes. Thank you so much.
Sure. Participant can raise the hand or put up your queries in Q&A section so that we can unmute you and you can directly interact with Edison.
Pranjal, please unmute yourself.
Uh, am I audible? Hello, sir. Thank you for
Yes.
your presentation. Yes, my query is that we are like at pre-incubation stage and bootstrapped based in Lucknow. So we are looking for, and also our application has been approved by Start in UP for incubation support. So how we choose our incubator and what are the criteria for finding a right incubator? And my the startup is in renewable energy. We are primarily dealing in the solar sector with customized solutions for homes and businesses. So it is what are the steps to move ahead for a startup who is just entering the market with a product which is already market fit, and we are innovating on the side of business model.
Got it. No, Pranjal, excellent question, and thanks for giving a brief introduction about your startup. See, where I let me put it this way. So, there in the life cycle of any entrepreneur, where you are is basically the seed germination stage. Here, in this case, you will probably require the right guidance to ensure that you don't make any mistakes. To your direct question of how do you select an incubator, see, my suggestion is that you should first uh, find the sector expertise within the incubator. So whoever is leading it, if they have the necessary reach or network to help you, because see, incubation is the preliminary stage, I would say. At that stage, you would require all your fundamentals to be sorted. When I say fundamentals, you should be in a private limited format. You should have a technically a two-member founding team. You should have all your paperwork ready. You should, if you have a product which you can directly take to the market, then that incubator should be able to demonstrate some sort of GTM capabilities to you. GTM means go to market strategy development, where how to approach your client, how will you go and reach out. And then of course comes a little bit on the monetary side, if they can help you, like in lieu of sweat or in lieu of cash or in lieu of any other service that they can provide. That is
Sir,
where
Yes, sir, I do understand, but you mentioned about private limited with two founders. What if there is it's a private limited with single founder, like OPCs are also put in the same category. So what are the processes for an OPC, which is again a private limited but with a single founder?
No, no. So in India, you cannot open a company without two directors. I mean,
Sir,
correct me if I'm wrong.
sorry, sir, but there is a like a latest version recently launched, and it is a OPC one person company, which is same as all the which enjoys all the benefit of a private limited, but it has a single founder, and over the time it can be graduated to a two founder, provided cross certain threshold in the turnover. So yes, sir, there is a company.
So,
There are companies, I would say, with single
no, no.
founder.
So I have under I whatever I learned, and maybe I'll have to check. There is a concept called sole proprietorship. There is a concept called
No, no, no.
partnership.
Yes, sole proprietorship is I understand, but there is a private limited company with two founders, and there is a private limited company with single founders,
Okay,
and one would.
I'm not aware of it, Pranjal. I can check. But if it is there, but if you're saying, I'll check. And as long as it is a private limited company, I think you can take in investments. That's the
Correct.
more point. It will
And can
not
I,
come in a, yeah.
yeah, just a second. Pranjal, are you registered with Startup India also? DIPP registration is done?
Yes, yes, sir, it's done.
Right.
And
So, see, usually once, in case you are raising funds from any of the investors, private limited company entity is required. And I'm sure Edison will agree on that, usually most of the investors, either angel or VCs, they are elected in funding a solo founders. So down the line, having a second founder will definitely be the need of the hour for your startup also. And same way conversion to a private limited kind of a thing, right?
sir, it's already a private limited, and but it's with single founder. I would like this. Yes, like I understand your point that investors feel reluctant to fund a single founder. That's why I raised this question that what about when a solo founder is starting a business, because government has allowed, they have given this private limited company to for a single founder, so it's named as
So
private
Pranjal,
limited.
to answer your question, uh, let's assume that one person company is also fundable. It is very important that you meet the criteria for the other four key ingredients, which is of course the type of product, which is basically your addressable market, whatever you are selling, whether it has got unit economics positivity. Third is of course the competition. If you're selling something which is already available in the market but at a different price, then maybe the differentiation does not play out. But if you have something which has more tech layer to it, or for that matter anything which is different, then of course if you meet those criterias, then the structuring part can be taken care of. What Vijay and I were trying to tell was, it is always better, it's better to tango. Like if you have another person who can help you in the execution part of it, it will be always beneficial. He or me she may not be holding as much equity as you hold, but there is always a case that and where I'm coming from is, it is not about your skill sets. It is about business continuity planning. God forbid you fall sick or you become unavailable for whatever reason. So there is a personal situation which requires your attention, which may be the primary or the priority for you. Then in that case, the business will suffer. And if you have taken money from external parties, they will expect the business to continue. And that is why a two-member team is always beneficial. It is not challenging the authority or your capability. It is more from a business continuity perspective. So while we understand that this concept is available, I have not seen any company being able to raise money on an OPC format yet. That is why I was unaware. So thanks for bringing this to light, and I
Sir,
will
I
do
have just
research.
shared a link in the chat as well. So
Yes, yes, yes.
OPCs can only raise funds through loans and non-convertible debentures.
Yeah, okay. All right. Yeah, and I see it is under a different section. It is section 262 of the Company Act. So that is why I may not be knowing about it, because the usual uh, formats in which the companies are funded are under the private limited company
Can we have the
structure.
next questions?
So we
Can we
have our next question from Devdas.
unmute
Krishnan.
him? Can we unmute him?
Sir, the question is in the chat. So I'll just read the question and then we can probably move on to the people who raise their hand. So Devdas, Krishnan's question is, can you explain the floor, cap, and discounting and valuation?
So this is a very, I would say, start class one to class seven question now. We have jumped six classes here. So when you talk about floor and cap, see what happens in the life cycle or journey of a particular startup. There are phases where you know your value. There are phases you don't know your value, or it is difficult to determine your value. So let's assume it is difficult to determine your value, because a founder will know his value. Believe me. If he doesn't, then he's not doing the right job. So assuming that you can't determine a value for a company, that means you will have a range in mind. Floor valuation is basically the lower end of the range. Cap valuation is at the higher end of the range. Whenever you are raising capital and you are not able to determine the value of the company at that particular point, the concept of floor and cap comes into play. In this case, it will be always with a discount or without a discount. So when you are raising and you believe your company is valued anything between, say, 10 crores to 20 crores, for example, units. Now you don't know whether it should be 10 crores or 20 crores, but you want money. So what you offer on the table is that I am needing, and then you determine how much dilution you want to do. Suppose you want 5 crores. So let's do the maths. If the valuation is 10 crore pre-money, you add 5 crores, the valuation becomes 15 crore post-money. 5 crores is the capital raise, you end up diluting 33%. Now, if you take the other example of, say, 20 crore as the cap, same 5 crores raised, pre-money is 15, add 5 crores into the investment, it becomes 20 crores. So you end up diluting 5 by 20, which is about 25%. So your range of dilution comes from 25% to 33%, depending on the floor and the cap. And the quantum raise is 5 crores. So now the maths works the way it is, that whenever there is a situation where the founder wants to dilute less, you tend to go with the floor, but you have to ensure that the investors are also aware of it. So when you sign, and this floors and cap valuation is always coming for a convertible note, and convertible note can be in the form of a CCD, which is convertible debentures, or in the form of CCPS, which is the compulsorily convertible preference shares. One is an equity instrument, other one is a debt instrument, but both have preference on the waterfall. And what is waterfall? When in case of in case of a liquidation, who gets paid first? That is basically the meaning of waterfall, which is called liquidation preference. So here in this case, when we are talking about the floor and the cap, so whenever you are raising the next round, you will say that the incoming investor will invest at the new price. The existing investor can convert his shares depending on the size of the round, either at floor or at cap or at a discount to the next round, which may be higher of the cap or lower of the cap. So technically, you are trying to ascertain a valuation, ascertaining a dilution, and making a range of it. So that is the concept of floor and cap. I hope I was able to explain.
Great. So there is one more query: funding opportunities in supply chain, agri-based startups. So
Requires a lot of capital. Believe me, that is one of the interest areas. Fortunately or unfortunately, uh, the essence of Strong and robust supply chain, especially in agriculture, is misunderstood by the farmers. It is for their own benefits, if you ask. Cold chain logistics, smooth supply chains will just, uh, I would not say remove, but mitigate the problems currently faced by our ecosystem, where prices move up and down because of the weather. Sometimes you have rains, unseasonal rains, you have droughts. There is no weather derivative market in the country. uh, Farmers have started taking insurance, but not everything is insured. Big farmers control a lot of interest, and the small farmers are marginalized. So to answer your question, we are very interested to. So you have there are two sectors if you look at it. Supply chain itself is a sector. Agriculture is the vertical, and supply chain is the segment. So both require disruption, both require money, both requires attention. Private capital can flow in as long as there is consistency in the regulations, and no one party takes undue advantage of the situation. Because once you invest capital, and then if there are road blockades and dharnas, it becomes very difficult for the investor to think whether the money is safe or not. So yeah, I'm very interested to look
Great.
at opportunities in agri-tech and supply chain.
IT team, please unmute Adil Ahmed.
Hello.
Adil, yes, you
Hi,
are
good
audible.
afternoon, Vijay sir and Addison sir. Thank you so much, Addison sir, for those valuable insight there. So I'll just briefly introduce myself. Am I audible?
Yes.
Yeah. So I'll just briefly introduce myself. My name is Adil, and we are building an educational networking platform to connect learners and educator. We are pretty much in half of edtech and half of social networking. And the reason why we are building it obviously is that key there's a lot of clutter where every student needs to get access to learning online, has to be there everywhere. So what we created is a marketplace for any institution, individual, educator, colleges to come on board on one platform and give accessibility to their learning platform or all the information that they can, and for the learners they can get over there and then can connect with their respective people. So we are at a seed stage. We have already been pre-funded by ventures from US, and some angels are there from Bangalore, some from New York already. The reason I am here and I have a question here in particular is I have two set of questions here. Firstly is ki how if you have any insight on any sort of networking platform or investment. I just want to know ki how viable it is to build a networking platform here in India, because no platform has ever come out here in India that has gone global or even pan India. For example, even Coup came out, alternative of Twitter. I don't know it's doing really well or not. Hike was another example that came in, but it shut down. But it's very difficult in that segment that an Indian really creates a networking platform that goes global. Like LinkedIn is there, it's global, but not from India. Facebook is there, WhatsApp is there, Instagram is there, but none of them actually came from India. So we are struggling to create that part, because any network platform really needs its user to be there. Unless and until they're not there, it's of no use. If WhatsApp nobody is there, nobody would be using WhatsApp. It's only because of the users they are on, everybody's on there. So one question is that, and the second is the viability of edtech investment here in India, particularly because I have been really talking in terms of number that you mentioned. Okay, creating revenue, yes, we have done that. Users, yes, we have done that. But there's a certain pessimist attitude towards the edtech, so I don't get a lot of reward in that. I'd just like to see your perspective on these two things in particular.
Okay. Thanks for those two questions. I'll take the second one first. See, the problem with EdTech is Baiju Ravindran. Okay.
Yeah.
And we all know that. Fortunately or unfortunately, and I've been very vocal about it, we have an EdTech investment in the portfolio, and that is doing pretty well.
Hmm.
But sometimes we are slaves to the environment. When I say use that terminology, uh, even if we choose to invest, it is about uh, the fact that the current sentiment is not great about a particular sector. Let's put it that edtech is not the flavor
Yeah.
of the month. But
Yes.
if you are a entrepreneur, your
Hmm.
core job is to not to look at what the other person has to say. It
Hmm.
is about performing to the extent that the other person mm, is almost looking at you. Just think
Hmm.
about the business or the Allen Institute in Kota. It is still running, right? It is not affected
Yes,
by.
yes. We are. I mean, we are sustainable.
Yeah, yeah. So concentrate on your own business and try and see to it that you hit your numbers, whatever you have promised to your existing investors.
Hmm.
As far as the new investors is concerned, believe me, every phenomenon is short-lived. When I say, even if you look at COVID, which was a black swan event and happens once every 100
Hmm.
years, uh,
Yeah.
we fought through and came out of it in 2 years, right? So every sentiment, negative or positive, has its own shelf life. That is to answer your second question.
Yeah.
Your first question was, why have we not seen any big community related platform in India or from India?
Yeah.
See, when you talk about the example of Ku, it was an actual copycat of Twitter.
Yeah.
So once you compete with a global name, no, we should not use the word Twitter anymore. It is X now.
Yeah.
So when you compare X, it has got complete global presence.
Hmm.
And if you come and say that I want to recreate something and do a vernacular take of it, because Twitter allows you to post vernacular content anyways today, right?
Hmm.
And you know that it has got multiple reach, and it can, your one statement can be viral in a matter of seconds, if not milliseconds.
Hmm.
So why would you want to reinvent the wheel, something
Yeah.
which is already proven?
Hmm.
And I personally believe that yes, there is enough space for a community driven. You need to find the right community. You need
Hmm.
to find your strengths. The problem is, if you look at some of the models, when Airbnb became famous, you had an OYO. When Uber became famous, you had an Ola. When
Yes.
when X was famous, you had a Coup. You can think originally. You can think of a sector which has still not been disrupted, and you require attention and exchange of ideas. See,
Yeah.
when you are talking about a FAQ kind of a format, Quora has been around for donkey's years, if you ask me.
Hmm.
You can go and put it, even GitHub, you can send questions and get some answers.
Yeah.
So, so think original, because see, money you can make only two ways. Either you think first or you think different.
Hmm.
If you are thinking second and you're thinking the same thing, you
Yeah.
may not be able to make the same money that the other person has made. I
True.
hope I.
True. Yes, I definitely agree, and that's why we had to change the trajectory because I think we have been operational for 3 years, and for the first year we did expect, okay, we'll be more concentrating on the users and bringing in more users on our platform. But obviously, because of the debacle in the edtech and people not really looking at users, how much traction, it's more about revenue and then about profitability, and then after that, it's more cash positive, like you said, and in order to really change and shift gear to becoming profitable, it is a task that we have been planning and executing since last November, where we are planning ki, okay, how do we change and tweak our model to create revenue from our from day zero, because we have created it. Now we cannot be concentrating on users, bringing in users and channelizing some mode after 2 or 3 years, which initially was the plan. But we had to shift and see ki, okay, now we have to go more into revenue generation from day zero, and that's what we have been working on since then. Thank you so much, sir, for answering both these questions. It's always lovely and to see so much information being put up, because I usually attend these things, but I don't get this plethora and depth of information everywhere. So thank you so much.
Thank you,
Thanks.
Adil. Adil, I think I have your deck with me, and down the line, probably let's connect back. Okay, I'll connect
Uh,
you.
yes, sir. Sure. Thank you.
Thank you.
Thank you, sir.
Thanks.
Can we unmute Dr.
See,
Swapnil?
one thing, yeah, sorry, I mean, I wanted to make a point after what Adil said. See, guys, understand one thing. You can create a 10 crore, 50 crore, 100 crore business, which is fantastic story for yourself. Make money for yourself, create wealth for yourself. You may or may not get funded. See, funding is not the be all and end all. You all want success in your careers and in your life. So running 100 crore business is not a matter of joke. And when it comes to exits, there are many forms of exits. One is, of course, you do an IPO, which is the classic situation where you run a company from a start to the finish line and you sell it to public basically. IPO is nothing but selling it to public. The other format is to sell it to a larger suitor or a larger competitor or a larger player who wants to buy you out and has seen the value of your business, which is called an M&A or a strategic acquisition. The third is you create enough wealth for yourself and your shareholders and you keep paying dividend. You can do an SME IPO. That market is growing pretty big. So don't lose heart if you are not getting funded by a VC, because VCs also are sitting with cash and are trying to put it to the best possible use. They look at uh, a good VC would probably look at 3 to 4 deals a day. They're looking at 120 companies a month. And to then select and put money in, say, even one company a month or two companies a month, you're looking at 24 companies. You have to manage that investment. It looks very glamorous from outside that you're covered in the newspaper and in the media, but believe me, it is not a great, not not a very easy job, because putting the money is, I think, the easiest part. Taking the money out and making returns out of it is the difficult part. I'm pretty sure very few people take bets on even public listed stocks like that. So success parameters are for you. You should be happy if you're running a 50 crore, 100 crore business. Believe me, funding is a new age jargon. If you are doing good, you can raise money, but raise money for growth, not for consumption. And there are multiple instances where you will be called successful when you sell your business or make sure you are returning the capital of your shareholders, because that is the trust you should always keep. Yes, now we can go to the next question.
Dr. Swapnil, if you can unmute yourself. Yeah.
Yeah, thank you, sir. First of all, I would like to give a big thank to sir, because whatever speech you have given is really insightful for the for the entrepreneur. My question is basically, okay, the thing is that when we are in any kind of business, okay, what are the other sources or the ways to earn the money apart from the government fundings? Because most of the time it happens that you know that the business it begins with the wealth, and then we have to grow ahead with it. So what are the other ways? I'm talking about in a very small scale. I'm not talking about the larger scale, because no, basically I'm a assistant professor in Amit University, and my student, okay, they want to just build up a small scale okay opportunity for themselves. So how they can begin, and what are the easiest ways to reach out these kind of fundings, and how to move ahead with it?
Thank you, Dr. Swapnil, for that question. And this is a very important question that plagues the mind of a lot of university students. And believe me, I went to IIT Delhi a few days ago and I was talking to the director there. See, engineering students specifically, they start any uh, business. I would say I'll start you choose the word business. It starts as a research project in say year two, between 2 or 3 students and one faculty. Okay, then suddenly there is a eureka moment where you find then there is a problem you are solving and there is a solution you have found. Then suddenly you want money and you want to put it under a business format. The higher education institutions, AICT has come up with a framework where they can fund it. When I say fund it, at least the first grant money, which is an equity grant of anything starting from say 15 lakhs up to 50 lakhs. Sometimes the sweet spot is 25 lakhs in case of IITs. That money is granted through the government by the institute under a particular name or format. So the first source of capital is that. Now, I have always maintained this position that both the students and the faculty should benefit out of it. So you have to come up with a tripartite network contract where the institute who is given you the first check, the student who is the potential founder along with the faculty, and the ecosystem as a whole should get benefit out of it. So if you get a Google out of an IIT Delhi, then everybody should benefit out of it by the equity stake you hold. And same is the case with Amity. If Amity is doing this, Amity should be able to make some rewards out of the whole play. So to and the different formats are under whichever sector you are operating. The government of India today gives a lot of grants, and it is channelized through different uh, government undertakings and bodies. So if you're talking about biotechnology, BIRAC has is the lead player who gives out all these equity grants. If you're talking about technology, there is Technology Development Board which gives out grants. All the IITs have their own incubators and accelerators. A university like Amity is also having Amity Capital Partners. They have Amity Innovation Incubator. So they are there with both the sets. Under the Atal and Innovation Scheme, there is a Samriddhi scheme which is funded by the Ministry of Electronics and Information, MeitY. That can be tapped into through different universities because that is a grant that is given. So as far as funding seed stage idea is concerned, this particular government has done a great job, I would say, in a sense that there are different ways for people to tap into money, which then you can start any idea or any particular startup. It's then how you use that money to take it to the next day where you can attract private investment is the most important question. If it is a tech company, then you should be able to raise money from accelerators, micro VCs, VCs. If it is a high tech play or you want to get into manufacturing, you can tap into funds from ONGC. If it is a oil and gas or IoT play, then of course ONGC, GAIL, BPCL, they all have their own funds. Shell has a fund. So depends on the sector, honestly, Doctor. Swapnil, because whichever sector you want, there is enough capital available as long as it's a good idea, fundable idea, and the team has the execution capabilities.
Right. Dr. Sapnil, I think what you should do is reach out to us. We'll let you know on various schemes that are available for faculties as well as students. Incubator has been doing that work. A lot of schemes are already with us. We help the startups at a very initial stage of prototype development till the next stage of seed fund.
Thank you, Vijay sir, and thank you, Edison sir, for your
Thank you.
guidance. So,
Thank
thank
We'll
you.
you.
we'll take one more question. I think Arjun has put up, what is the role of having applied patents in medtech device industry in terms of valuation for a pre-seed seed stage company, which is pre-revenue? And how does a VC see a company who is developing two products, both patent applied at prototype stage, which are synergetic to each other?
Great question. See, medtech has long gestation cycles. I'll start from there. I have covered healthcare and life sciences in my early career. So I understand that there are, even for a drug manufacturing company or a pharma company, there's the gestation period for any molecule development is roughly 10 to 12 years, if not more, where you hit the peak sales. Till that point, there is discovery, there is clinical one, two, three, then there is commercialization, there is marketing, there is manufacturing, and then there is sale. So in case of a medtech also, you start with an idea, you create the first prototype, you need clearances from different regulators and organizations. Then you need grant money to develop it to the stage that you get a finished product, a first ready to use product. Then you need some clinical studies to be completed before you get the the certificates for usage, and then you go for bulk production and to fine tune the cost before you make it a marketable product. So that point is very well taken, if you ask. If you have applied for a patent, so patent also goes through three stages. One is, of course, the application part. The second is the published part. And third is the granted part. Till the patent is granted, it is not a patent in the eyes of the investor. Having said that, if you have filed a patent which has been published and to be granted status, in all likelihood, we will consider that as a filed patent, which is good enough. Nature of patent is also very important. In medtech, you will probably end up getting utility and design patents more often than not because Uh, it's about bringing in efficiencies to the existing product, or maybe doing it in a different way. Very seldom will you get a product patent or a process patent if you're getting one that is excellent news and music to the eyes of the investor. As far as the potential pre-revenue versus revenue is concerned, we will want to understand which is the market you want to sell. Is it a direct consumer product, or you are selling it through the B2B channel? You have to tap into the hospital, share your revenues, share your uh, I would say margins. If that is the case, which are the hospitals you are targeting? If it is a mass scale product, you will probably want to do it with government funds, because government does it free of cost and has a much larger reach. If it is a high ticket item which can be used by people, oncology, kidney transplant, then you can go for private sector. What sort of capex can you pass out to the hospital which can then subsidize it? So we have looked at endoscopy medtech products which may be individually sold at 10, 15, 20 lakhs, but can be given to a hospital which can charge say 300 rupees per sitting and make the recover the capex recover the capex over a period of 6 to month or year, and then becomes a free model, and then you can have a revenue share model on. So there are multiple ways. Even the medtech is now connected to the tech. There are a lot of products which once fitted can relate real-time live data to a smartphone or a device, which then increases the potential revenue earning process, because then that can be sold as a form of a SaaS. The ecosystem is huge, and people are interested in medtech. There are a lot of companies in Israel and US which are doing this research, uh, be it prosthetics, be it precision instruments, be it any other technological development in the medtech space. And we are interested, but as long as the patent is in the file status, is something that we look at. If it is just an idea stage, or you have just raised the first equity grant to develop a prototype, or you have moved away from the prototype and now you're getting to a product market fit, that is the time you should tap into the VC. And there are honestly speaking VCs who invest only in medtech also. So you need to find out the players who come with that reach, because it is not about developing a product. It is also making sure that you are able to then sell it or connect it with the right hospital so that you have revenues in the future. So take money who adds strategic value and not just sits on the balance sheet or on the cap table for the sake of it. So those are my submissions to this question.
Right. I think, Edison, just because of the time constraint, we'll stop it for now. But last conclusive remarks from your side, what you want to give to the startup founders here before my colleague Sagar take over for the closing.
No, thanks a ton for setting this up. I look at 3, 4 companies a day. Want to listen to all of you. At times, it is very difficult to invest in all of you. So don't take a no as a stamp for your failure, first and foremost. Second is, irrespective of the market sentiment, there are entrepreneurs who are doing great work, and hard work always pays somewhere during the lifetime. Learning is extensive, and learning should be shared. Uh, Money is available on the table if you get your articulation and your execution correct. Articulation means pitch, execution means your ability to turn your idea into business. So I will leave you with those thoughts. Not everything is investable, but having said that, money is available for, I would put it this way, a lot of money is chasing very few good assets.
Great. Sagar, over to you.
Thank you, Vijay. On behalf of Amity Innovation Incubator, I take this opportunity of thanking Mr. Addison Appu, Vice President of Incubate, for his insightful session on fundraising, more so on breaking the complex landscape of funding and delving into topics such as startup evaluation, investment stages, valuation methods, etc., and a very entertaining Q&A answer session. I would also like to thank the audience for joining us today and for being such wonderful and patient listeners. In case of queries or information, you can reach out to us at info@aii.amity.edu. Sahil, if you can just post the email ID on the chat, that would be helpful. Until then, signing off. See you soon again. Thank you.
Thanks, everyone.
Thank you, Edison. Enjoy your day. Bye bye.
Thanks.